Good evening, all. Thanks for joining on a weekday. Today we are here to discuss the asset that is coming, the bond that is coming up on the platform. This bond is issued by Clix Capital. This is issued in July 23, right? So today we'll discuss the nitty-gritties of the entity of the bond, right? Anshul will take us to that. But before that, we'll just look at a snapshot of Wintwell. All right. Can we put up the screen? Yes. Yes, can we go to the next slide? Yes, so this is our core investment policy, right? This for the people who are joining webinar for the first time, right? So these are assets that are secured. So we basically bring out assets, currently bonds. These are senior secured bonds. So they are backed by some collateral like loan receivable, like gold loan, business loan, personal loan, etc. They offer you fixed return. So not related to market volatility of equity indexes. And third, these are issued by quality NBFCs or HFCs. NBFC is non-banking financial company and HFC is housing finance company, right? And what do you mean by quality in NBFC, right? One, it is low leverage. That means they have more equity in it. Second, there are good external equity investors. And third, they have good corporate governance, right? They have proper processes. It's not one-man army, right? There is proper processes team that takes care of it, of the business so that it can scale well. Right. So this is the core investment policy. Now let's go to the next slide. Right. Why Wintwell is we are building one platform for debt instruments. We have started bonds. Now we have SGBs also. We are bringing more instruments, fixed income instruments. Right. We believe in educating the user, the customers about the risk, structure, asset very transparently. Right. We don't want to sell assets. We are here to educate. Right. We build smooth investment flow. You can check the website or app. Right. Once you invest, you'll have consolidated view of all investment, and most of these opportunities are exclusive, available on Wintwell platform first, right? So you get access to the new instruments, right? Can we go to the next slide? Till now, we have sold bonds worth 1,000 crores. 1,000 crore is a big number for retail investors, right? So we are grateful that for that benchmark, right? About 47,000 investors have actually invested money, right? We've repaid these bonds have repaid for about 450 crores, right? There have been zero default, zero stress, zero delays in the portfolio. In fact, many of the NBFCs have gotten further round of equities, have been upgraded, etc. Right? So we thank you for your trust and support, right? Can we go to the next slide? Right now, if you see all the bonds on Wintwell platform, they are senior secured bonds. And there also you would see compared to other platforms, right? We are a curated platform, right? So we wouldn't we would not bring any other bond that is available in the market, right? So we do our due diligence. The bonds that pass our due diligence criteria, only those bonds we bring on the platform. And we also co-invest. Generally, we invest 2% of the issue size and hold till maturity, right? Now, we only bring senior secured bonds. Why? So senior secured bond is where there is some kind of collateral, right? And you can see in this slide, we can go to the next slide, right? So senior secured bonds, there is some collateral. So in case the entity is not able to pay, the senior secured bonds have access to the collateral. And what is that collateral? Generally, it is because these are NBFCs, which are lending loans. It is a pool of loans, right? So if you see on the risk priority, the highest priority is given to senior secured bonds. Senior, then there is, if there is anything left, it goes to senior unsecured bond, then there is subordinated debt, then there is hybrid, and then there is equity. Obviously, the risk itself, the risk also increases, the return also increases. So we believe in senior secured bond by picking the right entity, by picking the bond which is rightly structured, you can mitigate the risk, which you can't in senior unsecured or other kind of debt, right? Obviously, equity is very different, very different asset class itself, right? So therefore, we only bring senior secured bonds on the platform for retail investors. Can you go to the next slide? This comparison between different kind of bonds, senior secured bonds, senior unsecured bonds, and subordinated bonds, right? So senior secured bonds are secured by collateral, so they get first priority in bankruptcy proceedings. Senior unsecured bond are unsecured, subordinated bonds, obviously there is no collateral, right? So the risk also is medium, like risk is also comparable and return is also comparable, right? What we believe is in senior secured bond, you can manage the risk well. So the risk adjusted return is good, right? Therefore, we only bring senior secured bonds. Can we go to the next slide? Yeah. Now we'll talk about the asset and Anshul will take us through the asset. Anshul, over to you.
The new asset which is coming on the platform, like Ajinkya mentioned, it's a senior secured bond. The bond is issued by NBFC called as Clix Capital Services Private Limited. The NBFC was incorporated way back in February 1994, and it was incorporated by GE Group. Subsequently, in 2016, the present promoters of the company, Mr. Pramod Bhasin and Mr. Anil Chawla, along with a very marquee equity group called as Aeon Capital, bought the 100% stake in Clix Capital and started healthcare equipment financing, consumer financing, and MSME financing business lines. Entity did do some bit of corporate loans as well before COVID, but after COVID, starting over the past couple of years, these are the three main verticals in which entity is focusing on. And SME financing is the largest. Then there is consumer financing and healthcare equipment financing. This is a brief profile of the senior management. Mr. Rakesh Kaul is the CEO. He has been a veteran in this field, in the lending space. He joined Clix from RHB Malaysia Group, where he was heading the consumer banking finance. And Mr. Gagan is the CFO. Again, he has more than almost close to 2 decades of experience in the finance field, primarily in the treasury department of various other NBFCs. And Mr. Vikram is the CRO. Again, he has almost a couple of decades of experience, mostly in underwriting. This is the brief financial specs of the entity. The entity has a equity base or net worth of more than 2,000 CR. The portfolio is fairly large. The total asset under management is more than 4,000 crores. As we can see, the equity base of the entity is substantial. Hence, the leverage, which is essentially the debt to equity ratio, is on the lower side. The leverage of the entity has been under 2x. In terms of the lenders of the entity has more than 40 odd lenders in the funding profile, which means the funding profile is fairly diversified. There are lenders ranging from private sector banks to PSUs to large NBFCs to AIFs, etc. Some of the marquee debt lenders of the entity includes State Bank of India, Federal Bank, IDFC, large NBFCs like Manappuram, then DFIs like NABARD, and so on. Entity did see some stress in the portfolio during COVID. However, now the NPA numbers are well under control. The net NPA of the entity was only 1.5%. This is how the main top line numbers of the entity have moved over time. The leverage, like we can see, has remained within 2x. Entity did see some stress during COVID and during years 2021 and 2022. We have seen even in other entities, because it was an extreme kind of event, the NPA numbers did increase across the players in the industry. And so was the case with Clix. We can see the NPA numbers touched almost 5% during COVID in March 2022. However, last year, entity finished with a GNPA number of below 2.5%. Entity had a pretty low leverage, so the equity in the business was able to absorb any losses that came during the COVID. Coming to the new asset which is being launched, there are certain financial covenants which have been put in the deal as part of the structure. Covenants are conditions that the NBFC needs to comply. If the NBFC is not able to comply with any of the covenant, it is termed as that there is a breach in the covenant. And whatever money NBFC has borrowed as part of the NCD issue, it needs to immediately repay back the money to the investors. The covenants are put in place so that if there is any stress in the entity whatsoever, the investors can get the money repaid back as soon as possible. There are a lot of covenants. We have put here some of the key covenants which are there. The capitalization and leverage has been limited to 4x. We know the leverage of the entity is below 2x. However, regulations allow NBFCs to take leverage up to 6 to 7 times. But we don't want entity to take so much leverage, at least till our NCD is live. Hence, the leverage has been capped at 4 times. The NPA numbers, if there were to be any significant stress in the entity's portfolio, the NPA covenant will trigger, and entity will be obligated to repay back the money. Additionally, if entity is not able to sustain and grow the business in a profitable manner, that again will be a breach of covenant, and entity will be obligated to repay back the money immediately. Coming to some of the comfort points and concern points. First, the comfort points. We have seen the equity base in the company is substantial. It's more than 2,000 crores. And there isn't like too much debt on the balance sheet. So the leverage is on the lower side. The funding profile is fairly diversified. Entity has very marquee lenders, and there are more than 40 lenders on the funding profile. Additionally, as per a recent press release released by a rating agency, entity is expected to raise further equity from the promoters in current fiscal year, which again will increase the equity base or net worth of the entity, which already is fairly substantial. This will further increase once this equity infusion by the promoters takes place. Coming to the concern points, like no entity is perfect. There will be like there will be some concern points with any entity. Coming to the concern points with Clix, we saw in the previous slide, during COVID, the credit losses in the portfolio of the entity increased slightly. Even though COVID was an extreme event, it did cause some stress in the entity's portfolio. The NPA numbers touched almost 5%. However, subsequently in financial year 2023, credit cost has come down. The NPA numbers finished, the entity finished the fiscal year with NPA numbers below 2.5%. During COVID, the entity slowed down on the disbursement since there was stress building in the portfolio. So the AUM kind of flatlined to a certain extent. This is another concern point. We always like entities which are showing consistent growth. However, during the last fiscal, entity again started pushing the pedal on the growth front and achieved a 20% growth in the AUM. But this will be a key monitorable, how entity is able to grow the business in a sustained manner. These are the brief specs of the new bond which is going live tomorrow. It's a senior secured bond. It is backed by a pool of loans. The value of the collateral is 1.15 times the issue amount. The bond is giving 10.5% XAR returns. The repayments are structured in such a way that every 3 months, you will get back 1/5 of the principal along with the interest. So let's say you are investing 1 lakh rupee, 20,000 rupees worth of principal along with the interest will be repaid back to the investor every 3 months. The tenor of the bond is 15 months. The bond size is 25 crores, and the bonds are listed on the NSE exchange. Ajinkya?
Thank you, Anshul. So, so we'll just look at the risk involved in this bond, and generally these are the risks involved in all senior secured bonds, right? So, and we'll also speak about how these risks are mitigated, right? So there is liquidity risk, there is credit risk, and there is fraud risk. So liquidity risk is money being stuck. Credit risk is money being lost. Fraud risk is money being defrauded by the NBFC, right? So liquidity risk, there are two kinds of liquidity risk. Now this bond has tenure of 18 months, right? If you want to exit after 3 months. So you can only exit if there is a buyer. We help you find a buyer, but we do not guarantee liquidity, right? We do not charge anything, but we help you find buyer. That's how we mitigate this liquidity risk. And The other way investors can mitigate this risk is by diversifying their bond portfolio. If you invest in 5-10 bonds, even if one bond is illiquid, most of the other bonds will be liquid. There will be buyers, and you can take that money out unless something like COVID happens where the liquidity is completely dried, right? The other liquidity risk is if the NBFC goes bankrupt, then money recovery process can take time. Ideally, it should take 6 months, but it can take a lot longer, as we've seen in the past, right? We are also careful while choosing NBFC. If there is slight inclination of liquidity risk, also we don't bring that NBFC on the platform. Also, there are additional covenants that Anshul spoke about that make sure that if the entity is going downward, if there are any stress signal, then entity repays the investor faster. Like they're liable to pay much earlier than the maturity date, right? This is how the liquidity risk is mitigated, right? The investor must, it's good for investor to diversify to mitigate liquidity risk, right? Second is credit risk, right? So how credit risk is mitigated? Risk of losing money is by having good collateral, right? Quality collateral. So Anshul spoke about the collateral. We actively decide what collateral should be there and monitor it on a monthly basis and update in the dashboard, right? So not only we choose, we also monitor it on the regular basis after you make the investment. Third is the fraud risk. And this fraud is mainly by the NBFC promoter or the management, right? This is not a fraud at a ground level. That is generally mitigated by the NBFC itself. So how do we mitigate fraud risk? Is we do thorough diligence on the promoters, on the management, their background checks. We visit some branches, we check borrowers, we do a lot of third-party checks to make sure the processes are there to prevent fraud. And there is a decentralized system, a decentralized process for making decisions, right? And that's how the fraud can be avoided, right? That doesn't mean these risks are zero, right? But these risks are mitigated well, right? And to make sure we also have same incentives, our skin in the game is there. We also invest 2%, right? And that makes sure all these risks are thoroughly thought out. And when we are confident that these are managed well, then only we invest in these bonds and then bring on the platform, right? So these are the risks involved. Can you go to the next slide? Yes. Taxation is as per your tax lab. 10% TDS will be deducted on the interest. Obviously, if you're in 0% tax bracket, you can claim back the TDS. There is no single window to fulfill 15G form for tax exemption, a TDS exemption. We are working on that, and we should soon see a form where but it will still take some time. We are working as in we are asking the regulators to bring in such a feature, right? It's not in our hands. But we hope it will come soon, right? Can we go to the next slide? Yes. So investment timings are market hours. So you can visit win12.com. You can make the payment, right? And within 5 working days, bonds will be transferred to your demat account, right? If you face any problem in this process, please feel free to contact our education team, right? They are available on WhatsApp. The WhatsApp chat button is there on the website and app, right? And you can ping them and get help, and they'll make sure your query is solved, right? Can we go to the next slide? Yes. So this is our WhatsApp number. You don't need to save it. It is available on the website. You can also write us on hello@win12.com. And so we'll and yeah, again, we'll answer question and answer now. But if any of the question is unanswered, if you're not sure about the risk, do reach out to our education team. They'll be happy to get on one-on-one Zoom call to answer your questions, right? So let's start with questions. So there are some questions that came in on the Luma invite. Yes, let me just. Yes. So why is there a limit of 1 unit only, not only for this asset, but I also seen for others too? Anshul, can you answer this?
I think at a per transaction level, it's capped at 1 unit. It's happening because for investing more than 2 lakhs, there is a specific flow which the investors need to go through as per regulation, and that flow is pretty complicated. If you want to invest more than 1 units, you can do multiple transactions. Let's say if you want to invest 5 units, you can do 5 transactions of 1 unit each. We are working on a solution. I think over next 45 odd days, the solution should be live on the website. And in that new flow, you can invest like as many units as you want in a single transaction. But till then, I know the present flow is not like that smooth, and we are working on a solution. But for now, at a per transaction level, you can only purchase 1 unit. If you want to purchase more than 1 unit, you'll need to do multiple transactions.
Yes. Yeah. Next question. Why is profit of NBFC very less compared to its AUM?
So the profit of the NBFC, yes, it's slightly on the lower side compared to the AUM. And the main reason has been the stress that entities saw, especially during the past 3 years during COVID. Entity is profitable, but the profit is slightly on the lower side compared to the scale of the balance sheet. And like I said, it's mainly due to the COVID stress which was there in the portfolio. So entity had to do some write-offs, do some increased provisions in the balance sheet to manage the increased stress which COVID had caused in the balance sheet.
Got it. What is the collateral and how is this bond safe compared to a AAA or AA rated bond?
Sure. So like we discussed in the presentation, entity gives out loans as part of its day-to-day business. There are broadly 3-4 verticals that entity is operating in. One is the SME loans. Second is the healthcare financing. Third is the merchant loans which are there. These underlying loans are given as collateral. The size of the collateral is 1.15 times the bond amount. That's the collateral which is available in case in the hypothetical scenario that entity were to default in the obligation. Coming to the second query, how safe or risky it is compared to, let's say, AA, AAA rated bonds. So at Windfield, like, don't primarily look at the rating. There are a lot of AA plus entities where we don't have comfort. Especially in the market, like we are seeing, there are a couple of AA category NBFCs which are giving yields as high as 12%. The reason they are giving yields as high as 12% is because not many lenders in the market are willing to give funds to them. Hence, even though they are AA rated, they are having to give, they are borrowing at the levels of 12 to 12.5%. And in spite of that, their rating is in the AA category. So it went to like, we don't look at the rating as the primary filter. Instead the filters that we apply are basis our own framework. The framework includes parameters like whether the entity has good promoter backing or not, how diversified is the funding profile of the entity, what is the leverage of the entity, what are the NPA numbers compared to the industry standard, what is the unit economics of the entity. These are the parameters which we use to evaluate whether an entity can be onboarded or not. And only those entities which meet these kind of stringent filters get onboarded on the Wind platform. So there is no like right answer, because like even in AA category, there are so many good and bad entities. So one needs to like evaluate this is which entity we are comparing this with.
Yes. Next question is, what is Clix doing different compared to other MSME lenders? How good is it? How good is the collection efficiency? And what is the ALM levels historically and present?
So I think there are 3 questions to this. Coming to the ALM, which is a very objective question. The ALM is positive across buckets and at a cumulative level. For some of the attendees in the webinar, ALM refers to asset liability mismatch. We know NBFCs, they borrow money, and that money is used to give loans to its borrowers, to the individual retail borrowers. Now, a good NBFC will always match the asset profile with the liability profile, which means if NBFC is giving out loans, let's say having a tenure of 2 to 3 years, then that NBFC on average will borrow money for 2 to 3 years, so that there is no asset liability mismatch. If the tenure of the liabilities is shorter than the tenure of the assets, it can result in a cash flow mismatch of the entity, which can lead to default. So coming to Clix, the ALM is positive, which means whatever money entity is expected to get from the assets from its portfolio is more than adequate to meet the liabilities, the obligations under the liabilities. Second question was, what is Clix doing differently compared to MSME lenders? MSME underwriting in India is like kind of becoming templatized basis GST, bank account, balances, etc. MSMEs are underwritten, and Clix is following similar frameworks only, I'll say. But 2-3 different things that Clix is doing is they are developing specialization in certain sectors within MSME. For example, healthcare financing and school financing are two major verticals that Clix is focusing a lot in, and they are developing specialization to underwrite borrowers coming from these two sectors. We know like Clix was earlier part of GE Group, and GE Group had a lot of presence in the healthcare equipment financing vertical. So that specialization is coming from there as well. And some of the other segments like school financing, etc. Clix is doubling down on getting specialized credit analysts to underwrite cases coming from these sectors. And obviously, like in terms of underwriting the other sectors, they're developing their own proprietary models, their own underwriting frameworks to underwrite borrowers coming from other sectors. Ajinkya, what was the third question?
How good is the collection efficiency?
Yeah, I mean, the NPA numbers we have seen, they have come down to below 3% at a gross level. And at a net NPA levels, it's close to 1.5%.
Got it. What is the distribution of their borrowings, average cost of borrowing, average rate of loan interest rate, average ticket size, NIM historically and present?
Sure. So ballpark, they are lending at somewhere around 15.5 to 16%. They are borrowing in the range of 10 to 11%. And these numbers have been stable for past few quarters, etc. So this translates to a NIM of around 5 to 6%.
There is one query. What is 10.5% XIR? What happens to money if there is market crash like in the year of 2020?
So these are like fixed return instruments. There is no linkage with the market. As long as Clix, which is the company to whom you're giving money to, survives, they don't go bankrupt. Company is obligated to repay back your investment along with 10.5% XIR returns. Doesn't matter whether equity market goes up by 50% or goes down by 50%. These are fixed income instrument, which means Clix is obligated. They're legally bound to repay back the money along with 10.5% returns, XIR returns. The only scenario where you will not get back your money is that Clix has gone bankrupt. And that's the risk you have to like evaluate. What are the chances that within 15 months, Clix may go bankrupt? If the scenario doesn't play out, Clix is legally bound to repay back the money along with 10.5% XIR returns.
Yeah. In spite of increased interest rate in the lending market, we find that IRR of all Wintwell bond range from 9 to 11.5% only. Yeah.
I think they have like increased over the past year or so. Earlier, we used to get bonds even at 9%. Now, I think over the past 3-4 months, all the bonds have been in the range of 10% or higher. There are entities which are giving like much higher yield as well, but we are avoiding bringing those entities on the platform. Secondly, you'll see most of the bonds that we are bringing on the platform, these have shorter tenor. Bulk of the bonds will have tenors ranging between 12 to 18 months. Now, to the same entity, if we were to give, let's say, 2-year or 3-year kind of money, the yields can be increased by 50 to 100 basis points. But we believe that the risk increases substantially as the tenor of the bond increases. So to mitigate the risk, we do two things. One is restrict the tenor of the bonds. Very rarely do we cross 18 months. Most of the bonds will have tenor less than equal to 18 months. Secondly, and that is something very unique to Vint, is we do amortization in the bond. More than 80% of the bonds in India, they are something called as bullet bond, which means the entity repays back the principal in one go at the end of the tenor. If this bond were to be a bullet bond, 15 months bullet bond, entity will repay back the principal in one go at the end of 15 months. But what we do is we bring amortization bonds, which means entity repays back the principal in tranches. The beauty of amortization bonds is even if a default were to happen, it's not like the entire money will get stuck. Let's say in this bond only, let's say in a hypothetical scenario, the entity ends up defaulting after 13 months. In this scenario, 80% of the money would have already come back to you because entity is repaying back 20% of the money every 3 months. And the money which will be stuck will be only 1/5, will be only balance 20%. However, if this bond were to be bullet bond, even if the entity defaults after 13 months, the entire 100% of the money will get stuck. And bullet bonds again offer much higher pricing because entity gets the money for a longer time. So they are happy paying like a few basis points higher compared to amortization bonds. Because we restrict the tenor of the bonds to less than 18 months, and because we insist on doing amortized bonds, the yield that entity offers tends to be like slightly lower compared to a very long tenor bullet bond. But we believe the risk in such short tenor amortized bonds is far, far lower compared to long tenor bullet bonds. And hence we like don't only chase yield, we like try to mitigate risk as well in the bonds that we are bringing on the platform.
Yeah. No, you just mentioned, so there is one question, there is some other platform which is giving same entity bond at 11.5%. What is the reason for that difference? So we just checked that is a 24-month bullet payment tenure, right? So
yeah, so I mean, like if I were to be an investor, doesn't make sense to lock money in such a long tenor bullet bond, because let's say in a hypothetical scenario, if the entity were to default after 18, 19, 20 months, my 100% of the money is at risk. The entire money will get stuck. While in case of a 15-month bond, the entire money would have come back. And on top of that, our bond is amortizing, which means every 3 months, we are getting back 20% of our principal back.
Yes. If NBFC has borrowed some money from banks and other borrowers, after bankruptcy proceedings, money will be first paid to borrowers or senior secured bondholders?
So the borrowings that NBFCs do from banks, they are also senior secured borrowings only. So all the senior secured lenders, be it banks, be it NCD investors, they are something what we call as pari passu, which means all have equal ranking in the bankruptcy court. Whatever recoveries come are distributed equally amongst all the senior secured lenders. It's not like a bank who is a senior secured lender has a higher or junior priority compared to a NCD investor in a senior secured loan. All the senior secured lenders have equal standing in the eyes of law.
Is Clix listed on stock exchange?
Clix is not listed, but the bond that we are bringing will be listed on the stock exchange. When we say whether an entity is listed on exchange or not, what we generally mean is whether the equity shares of the entity are listed or not. In case of Clix, the equity shares are not listed. However, the bond that we are bringing is listed on the stock exchange.
Yes. Who is regulator for Vint12 bonds?
So last December, SEBI came out with the set of regulations called as Online Bond Platform Regulations. And Vint12 is operating under those regulations. We have also applied for a broking license, which is in like very advanced stages at SEBI. Once the approval comes for that broking license, will be like very formally regulated with a proper broking number under the SEBI broking regulations. Within that, under the OBP online bond platform sub-regulations.
Got it. You told me you invest 2%. We as a promoters will invest, or Vint12 operational money will be. So Vint12 operational money or equity money is invested. Since these 1 lakh bonds, we can't invest. We don't have that big portfolio to invest in 1 lakh bond of every bond. In 10,000 bonds, we used to invest personally also as promoter, and as a company, we used to invest 2%, right? So in 10,000 bonds, we do invest. In 1 lakh bonds, the company invests 2%. Yes, the recording will be available. So there is one question. Somebody joined the call late. The recording will be available tonight itself. They have diversified borrowing profile, but why is their NBFC borrowing increasing? Are they finding it difficult to raise money from banks, especially from the big four private sector banks?
It's a function of like, I think, supply and demand. Like whenever entity needs funds quickly, they tend to like borrow from NBFCs, AIFs, etc. Because banks in India like move slower compared to other nimble lenders like NBFCs, etc. So I think NBFC Clix has onboarded a lot more PSUs and private sector banks as well over the past year compared to the year before. But I think a lot of sanctions are in the process, and even the other banks which are not on the funding profile, this is the discussions with the entity. I think they will also get onboarded pretty soon. And what entity has indicated is like over the next year or so, they'll be focusing a lot more on the bank borrowings compared to other sources. Having said that, like any treasury of like any entity wants to diversify its funding profile as much as possible. So even though like banks may be ready to give like lot of money, NBFC wants to diversify its funding profile so that it's not dependent on only one pool of capital. There should be banks, there should be AIFs, there should be NBFCs, there should be retail capital now via platforms like Wind. So all the NBFCs, like they want to diversify their sources of funding.
Is there 10% TDS and 30% income tax bracket? Yes, 10% TDS is applicable regardless of your tax bracket. We'll have to pay additional when you file income tax if you're in 30% tax bracket. If you're in 10% tax bracket, you don't have to. If you're in 0, you can file income tax return and get that money back. Is this collateral kept safe and secured from again giving it as collateral for another bond or debt?
Yes, so like same collateral cannot be given as collateral for any other borrowing, and entities auditors like on a recurring basis, they ensure that whatever collateral entity is giving as security for any of the borrowing is something called as unencumbered, which means any other lender doesn't have like a preferred charge or right over that collateral.
Bond is secured with collateral of loans, but if these loans themselves are unsecured, like loans where end customer has not given anything to the NBFC, so how does this security add value? If this is a gold loan, definitely it is secure. That gold can be sold if end borrower doesn't prepay. But if that end borrow loan has nothing kept in collateral, I think it kills the purpose of secure here.
I'll first like give a breakup of the entity's balance sheet, like what portion is secured and what is unsecured. So roughly 60 to 70% of the entity's balance sheet is secured by some kind of collateral. Can be, let's say, a property like house, etc. Can be healthcare equipment which entity has financed. Can be some form of FLDG guarantee, etc. And only roughly one third of the entity consists of unsecured loans. And the same ratio is being mirrored in our underlying collateral as well, which means almost 2/3 of our underlying collateral is backed by some kind of collateral, either a healthcare equipment, either a property, and so on. And only 1/3 consists of unsecured loans. Having said that, even unsecured loans, they do offer a lot of security to us as lenders. Because let's say a bond is backed by 100% of unsecured loans. And let's say the underlying pool has 100 underlying unsecured loans which are given. Typically, the default rates that we see in unsecured personal loan segment ranges between 4 to 6%. Even in a stress scenario, let's say the default rate becomes 3 times, it becomes 15%. Still 85% of my money will come back from those underlying unsecured personal loans. So it's not like having unsecured personal loans as collateral doesn't give me any value, doesn't give me any security, because it's not like all the loans in that underlying pool of unsecured loans will end up defaulting. Our base case loss is 4 to 5%. In an extreme scenario, it may become 15%. Still, 85% of my money will be able to recover from those performing unsecured personal loans. So it's incorrect to say that if the underlying collateral pool consists of unsecured loans, there is no value. One can say that we may be able to recover only 85%, 90%, but even a bond which is backed by 100% unsecured loans does offer a lot more security, does give a lot of comfort to the investors. In this case, like I said, 2/3 of the underlying collateral pool is backed by secured loans. Can be property, can be healthcare equipment, and roughly 1/3 is backed by unsecured loans.
While I
And
want,
additionally, there is a 15% over collect, which means the collateral is 1.15 times the bond amount.
while I wanted to restrict myself to 5-10% of my portfolio to this high risk bond, it has exceeded that allocation since the ticket size increased from 10K to 1 lakh for most bonds. How do you recommend we further filter assets to invest? Asking since I end up investing in every asset on the platform.
You want to take this, Ajinkya?
I mean, there is no right answer to this, right? What we are planning to bring is kind of one bouquet of bonds, you can say, wherein if you invest 1 lakh, you will get exposure to 20 bonds, right? Till then, I think you have to find a solution or your own, right? Like if personally, I would stick to NBFCs with lower leverage, right? And just select basis on that. But there is no one right answer. Anshul, you want to add? Feel free to add.
Yeah, I mean, if you're like feeling uncomfortable increasing the allocation of bonds in your portfolio, I think it's best to wait it out. Most of the bonds, like I said, are amortizing bonds. So those 15% bonds in your portfolio will be amortizing almost on a quarterly basis. So what you can do is like, if you feel the risk is becoming higher, the exposure in this segment is becoming higher, it may be like a time to like hold off from taking incremental exposure and only replenish whatever rundown is happening. Let's say on a quarterly basis, 1 lakh worth of bonds are principal repayments is coming back to you as amortization on the existing bonds. Only replenish that 1 lakh rundown with a new exposure. And like, don't go overboard if you're not like comfortable with the further increase in the exposure in your portfolio.
What major events like COVID can trigger NPAs across NBFCs?
Yeah, I mean, like COVID is a classic example. In most of the sectors during COVID, the NPA numbers increased. They almost doubled. So in sectors where we used to see 3-4% NPA numbers, during COVID, the NPA numbers increased to 8, 9, and 10%. But COVID, I think, is kind of a black swan kind of event. It's a very extreme event, and NPA numbers are bound to increase during such extreme events. It gives us a lot of comfort to like onboard those entities which were able to survive even during COVID times, because like I said, like COVID was one of the most extreme events that one can witness. So if a entity's management was able to sail through those kind of extreme events, it gives us a lot of comfort. The entity is experienced, the promoters know how to run the business. And I think in events like these is where low leverage also kicks in, because low leverage means there is a lot more equity in the business. So any losses that come, the equity can absorb those increased losses, and the risks don't flow to the debt investors. So lowly leveraged entities which have seen tough times where the management knows how to handle the ship during such turbulent times, I think those are like great entities to take exposure to.
What tech platforms do they use for consumer lending?
So they have there are broadly two tech platforms, or other three. One is a loan origination system, which is used to originate leads, where you will like check the CIBIL of the borrower, do the CIBIL checks, etc. Second is the credit underwriting system, which is typically built in-house, which consists of proprietary models to see what's the average banking balance, what's the GST data of the borrower, etc. And third is the LMS, loan management system. Once entity has like given out loans to, let's say, thousands of borrowers, all the data gets stored in something called as LMS, loan management system. So these are typically three of the platforms which are required for any NBFC to do its business: LOS, loan origination system, credit underwriting models, and LMS, which is the loan management system.
Yeah. In general, how frequently do we see corporates going default on secured bonds, trying to compare to FDs, whether it increased the risk by 10% chances of loss or 90% chances of loss?
So most of the investment grade entities, the probability of default is in the range of 1 to 3%.
Got it.
So this is the historical data, and this is probability of default, that out of every 100 entities, let's say 2 may end up defaulting. But this is not the ultimate loss which will happen to the investor. Let's say out of these 100 entities, 2 have defaulted historically. Now, in these defaulting entities, there'll be senior secured lenders and there'll be unsecured lenders. In senior secured lenders, the collateral will kick in. The senior secured lenders will try to get recovery of their money from the underlying collateral. So the ultimate loss to the senior secured lenders in these defaulting entities can be very small, can be zero as well. So this 1 to 3% number is the probability of default, which means out of 100 entities, 1 to 3 entities may end up defaulting. This does not include the recovery from the underlying collateral. If we include that, the net number will be much lower.
Will the PFC bond be available on Win12 platform? What is PFC bond?
It's Power Finance Corporation. I think the yield is like too low. We think like now a lot of FDs are giving yields in the range of 8.5 to 9%. And all these AAA rated government-backed bonds are giving yields in the range of 7.5 to 8 quarter kind of range. And these are long tenor illiquid bonds. So for a retail investor, it makes much more sense to invest in a 8 quarter to 8.5% FD. If the FD issuer is a bank, it's like a sovereign guaranteed up to 5 lakh, and FD is liquid at your disposal. You can pay a 1% penalty and get back your money instantly. So it doesn't make a lot of sense for retail investors to invest in bonds giving 8% returns when FDs itself is giving 8.25 to 8.5% kind of returns.
Got it. Any updates on small finance bank FD? It is work in progress. It should happen soon. What other fixed income classes is in Wind proposing in future? Will Wind show skin in the game for those? Approx when are they expected to go live? So wherever we will bring curated assets, we will have skin in the game. But like we have SGB, which is a very sovereign gold bond, right? There we don't have any skin in the game. We're launching the small finance bank FDs, right? We'll not have skin in the game there, right? But if we bring any, like I sometime back I mentioned there is one instrument we are basically bringing, where in 1 lakh ticket size there will be underlying 20 bonds. There, if it is a curated product, we'll have skin in the game, right? These dates, I mean, because of there are so much regulation involved, we can't really tell you the dates because we don't know, right? We try to push it every day and we'll bring it as fast as we can. If I invest in a bond which has accrued interest, do I have to pay TDS only on my gains or total gains? Yes, Anshu.
I'll ask like team to respond to this message. I think they checked recently about this query with some of the experts. So I'll ask the team to revert on this query.
Got it. Can we expect more bonds with monthly interest payment than a quarterly model?
Yes. We are. There are some bonds in the pipeline wherein the interest repayment will happen on a monthly basis.
Earlier, all Vint offerings used to sell out quickly. Recently, few have remained live for some months. Vint's reading of why so?
I think like earlier, our supply engine was slower compared to the demand engine. Now, like we built a lot of capacity in house, hired a lot more in the risk team in the our origination team. So our supply engine is now running, I think, slightly more efficiently compared to the demand engine. And this will happen like at times we'll have like more supply of bonds than there is demand, and in other times it will be the other way around. But one thing we are seeing is like investors are like preferring higher yield and lower tenor bonds. So wherever like yield is like below 10, those kind of bonds are selling slightly slowly compared to bonds giving more than 10% return. Though like it's a general like suggestion to the investors that don't chase only returns, like evaluate the risk as well. If there is a good entity, even though it may be offering like 10% or even below 10%, but if the risks are lower, it's worthwhile investing in those bonds as well, because it's possible the risk adjusted returns in those bonds are superior to bonds where the yields are higher, but risk also may be slightly on the higher side. So always try to diversify. Don't like only look at the returns, look at the risk as well. Have some low risk bonds, have some medium risk bonds, and have some like slightly higher risk bonds.
Yes. There is one more query regarding tax, query by Ayush. I'll ask team to answer it. Anush, please answer. How to convince parent as it is better than FDs? Like if you are a student and you need to convince them for this, what firm reason you can give? Look, you should not force them or convince them. You should educate them. If they are fine taking the risk, they will invest, right? And especially people who are retired, they may not be fine with such risk, right? But in general, it's their money, it's their choice, right? You could invite them to join a webinar and right, and they can decide on their own, or you can explain them the risk. But this, like we generally don't think that this kind of thing should be convinced or should be sold. Not sure if this is the right forum for platform feature request, but it is helpful. We can show the current amount for bonds and SGB separately. It will help with calculating asset allocation between debt and gold. Team, please take this as a feedback. Kritik, just send it to the product team also. Right. Why not do YouTube live instead of Zoom webinar? I don't know. Since start we have been doing Zoom. No strong reason as such. Under what section of income tax I need to consider while filing tax return for my earning I have from Vint bond?
I'll ask team to like answer the exact section which is relevant here.
Ajinkya, Anshul, question for you, not for this forum. Guess, I am 40 plus, looking for building retirement portfolio. New investor. I know you mentioned equity is answer, not bond. But if an average equity return is 12%, bond is giving 10-11% with safety. Can I get your email for some of the financial suggestions? I'm not sure where to go for non-biased suggestion. As LIC agents give their products only. Same with fund houses. Also given more than 60-70 funds returned lower than index in long term. Need some personal help in getting outlook for this, please. Look, I mean, we are not even qualified to do this, right? But we'll be happy to get on a call, but we cannot advise, and we are not even experts. I mean, forget whether we can or not. We simply don't have the expertise, right? But you could drop me a mail on ajinkya@vintwell.com. I'll see what I can do. But I'm not an expert at all. Neither I have any license to do so. But I'll be most likely I'll be able to redirect you to some sites and some groups. But I'll be happy to get on a call. Will we get Navi NCD soon and Win12 platform secondary sale?
Yes, we'll be bringing Navi NCD. Hopefully by the end of this month or early next month.
Yes, and at a better yield also, right?
Yes.
SGBs in Win12 are higher for higher time period. Can we expect SGBs for low time period? So look, in SGBs, we are not the issuers. We just tell you the best SGBs to invest from what is available in the market, right? So we can't really control on that. But yeah, so Anshul, any solution to this?
So on our SGB page, like if you scroll down, there will be top 10 SGBs which are giving maximum yield. In that list, there'll be some SGBs having higher tenor and some SGBs having short tenor as well. So you can like pick those short tenor SGBs and maybe like invest in them.
Can we expect any PSU bonds with 1 lakh ticket size?
So the challenge is same, like most of the PSU bonds, which are like truly PSU bonds, give yields in the range of 7.5 to 8.25%. Since those are like government bond, government backed having AAA rating, the yield is 50 to 100 basis point over what government bonds are offering. And for retail investors, we believe in today's market, FDs are giving higher returns compared to these PSU bonds. These PSU bonds will have long tenor, would be illiquid, while FDs on the other hand have like very high liquidity. So it doesn't make like too much sense for retail investors to invest in bonds giving 7.5 or 7.7% kind of returns. They are better off investing in FDs, maybe a small finance bank FD or a AAA NBFC FD, rather than investing in these bonds. Hence, we have avoided bringing those bonds on the platform. There are a few state government bonds being marketed in the industry, but again, those bonds are also not risk-free. They don't have the same bonds as like central government bonds. There have been instances in the past wherein bonds issued by even state governments or guaranteed by state governments have ended up defaulting. Classic case is Andhra Pradesh bond. When the AP Telangana bifurcation happened, like both states got into dispute who will be ultimately paying the repayments under the bond. And those bonds are in default even today. So just because the issuer is a PSU or a state government, don't assume they are risk-free. It's a general word of caution which I'll have. Because in the past, even state guaranteed bonds have ended up defaulting.
Win12 SGBs are regulated by like are issued by, I guess, RBI, and like since they are listed on, like are they even listed, Anshul? Yeah, they're traded on exchange, so they are regulated by SEBI also. Do you suggest any limit for investor per NBFC MFI based on the risk diversification?
Yeah, whatever like allocation you're doing towards bonds, plan to diversify across at least 10 different NBFCs.
Got it. Sir, I am 19-year-old and I just started showing interest in market investment bonds. How should I start and what mistakes should I avoid while learning?
I think 2-3 thumb rules will be like start small. On our platform, there are bonds having ticket size as low as 1,000 rupees also. So maybe start with the 1,000 rupees only. Don't go overboard. Second would be don't only chase returns. Look at the financial strength of the entity as well. And third would be diversify. Even if you want to invest, let's say 20,000 rupees, try to diversify across at least 5 different bonds, if not more. And only once you like completely understand the product, the risk in the product, then only increase your allocation.
Yeah, I think we are at the end of the questions. Can you improve the investment summary report to also include gains and TDS deducted at financial year ending? I have many entries shown in my Okay, I'll share this feedback. I have many entries on my 26 AS for 31st March, which mention interest and TDS, which I haven't received yet. Okay, team, what is Ritik? What is this query? Do you have an answer right now, or okay? Anyway, take this question and we'll definitely improve. But like, give whatever is our feedback on this to hear also. Great. We are at the end of our question. We'll wait for a couple of minutes more in case you have any questions. PM who asked this like investment summary report question, please reach out to our CX. We'll solve it. Can Wintwealth put risk factor as per your analysis for every bond?
We've already started putting on the asset page. So in the asset page, we mentioned both the comfort points and the concern points. And whatever red flags we see, we ensure they are included in the section called as what are the risks of this NBFC. It's there on the asset page.
Yes. If there are no more questions, we'll wrap this up. Thank you for everyone for joining. If you still have any questions, feel free to reach out to our education team and we'll be happy to help. Thank you. Happy investing. Good night.